Today, I'm excited to be joined by Parag Sanghani from Westwood Holdings Group. Parag is a senior portfolio manager, specializes on energy. We've got a two-part series today. The first part is going to be on traditional energy. We're going to dive into oil and natural gas, among other topics. And then we're going to have a second part series, which will be released later, on clean and renewable energy. Thanks for joining. I appreciate you for coming today. I'm looking forward to your expertise. To start, can you tell us a little bit about your background?
Sure, and thanks for having me today. In terms of my background, I actually started in energy 20 years ago in 2004, right as oil prices were crossing over $30 a barrel. So back then, $30 was a good thing. But from a way of background, I did my undergrad at Texas. I'm born and raised in Houston. I've had energy in the family for years. And when I joined the energy industry, I started on the sell side. And what was exciting was that I got a chance to really learn the macro in and outs of the industry, running the supply demand models for oil and natural gas, in addition to covering individual companies in the oil services sector. So I had a really good education to start my career. And then from there, in 2008, I actually moved over to the buy side with my partners, Greg Reed and Ted Gardner. The three of us actually have been together since 2008. Running midstream portfolios and then broader energy portfolios as well. And today we manage about $2 billion across several different strategies.
Wow. And you just launched two new ETFs recently. Can you tell us about those ETFs?
Absolutely. So the two ETFs, we've got a midstream ETF, ticker MDST, and we've got a broad energy ETF called WEEI, WE. And both of them use a covered call strategy to really harvest cash flows from the industry. So today, midstream companies pay about a 5.5% yield. Add on a covered call portfolio on top of that, you can generate another 5 to 6% per year, generating double-digit yields over a course of a year. Same thing with broad energy. Broad energy is a little bit more volatile than midstream. So options premiums actually generate a lot of value on broad energy. And today we're able to actually generate about a 3 to 3.5% yield on the underlying portfolio in broad energy, and then boost that up to double digits with that covered call portfolio.
Wow, so the covered call really allows you to generate a lot more income than you would naturally through a direct investment in energy.
That's right.
Why now? Why are you launching ETFs in this environment right now?
Yeah, if we think of what's happened over the last few years, in 2020, we went through the COVID shutdowns, which really brought into question how much traditional energy are we going to use in the future. And these stocks got annihilated, for lack of a better word. And so the last several years has just been a recovery from those depressed COVID lows. And when we look at valuations today, where we look at growth rates over the next 3 to 5 years, we're now approaching a level that we think is much more fair valued. And so by selling calls on an underlying portfolio that we like, we think generates a good opportunity for investors that are focused on income generation today relative to, say, a few years ago when the valuations were depressed.
So on midstream energy, how do you actually approach investing in midstream energy?
Yeah, what's really exciting about midstream today is that we have growth reaccelerating at a time when there's still excess capacity in the system. So companies today are trading at valuations that are below 10-year averages, but about fair versus 5-year averages. But they have lower leverage than they've ever had. They have better returns on invested capital than they've ever had as an industry. And they're paying out less per unit of cash flow that they're generating as their dividend. So the companies themselves are just operating better than they really ever have. And so when we look at the opportunity set, we say, wow, we're getting close to 10-year averages, but there could be multiple expansion above and beyond this if they keep operating in a healthy fashion. So what we look at when we're building these portfolios is really focusing on those key metrics for those companies.
That's interesting. And so that's a big investment thesis then behind your MDST midstream ETF.
That's right.
Tell me about how midstream performs in an environment we have now where inflation's tending to go down a little bit.
Yeah, absolutely. So when we think of what the biggest drivers are for midstream, there is the yield, and then there's the growth on that yield over time. If we look at valuations today are about fair. They're at 5-year averages and just slightly below 10-year averages today. So from a yield and a growth on that yield standpoint, today the industry is growing from a volume growth standpoint at 3% per year. And then if we think of just operating efficiencies, et cetera, you can see EBITDA growing right around 5 to 6% a year. And so if we can translate that EBITDA growth into dividend growth, then you're looking at 6% dividend growth, 5.5% yield. That gets you a really healthy double-digit expected return. The catch, though, is if we layer on an additional option portfolio, we're thinking if we can get 11% a year, only 6% of that is price appreciation. Well, today options are priced with quite a bit of volatility in them, and selling monthly options that are typically 3 to 5% out of the money, more often than not, we're actually able to book that premium and then deliver that to investors. So now you're generating, call it 5 to 6% a year on option premium. On top of that, you're getting your 5 to 6 yield, and you're getting your 5 to 6 growth. So combined, you get something that's actually really exciting. There's a catch, though, and there's always a catch, which is if prices go up quickly, like we've seen this year on the midstream side, we will get called out. So we've had positions get called away, and so we don't think 100% of that option premium will get translated into true distributions, but we think that actually we have data on this. We think that right around 70% of it will get will get translated into actual distribution.
Is a premium on the writing those calls.
Exactly.
Interesting. So while we're talking about midstream, one of the developments that's happened the last month is the Matterhorn pipeline, which has now started to carry natural gas out of West Texas. Can you explain what the relevance of the Matterhorn pipeline, why it was being built, why it's important in natural gas, and really fracking in general, oil fracking as well in West Texas?
Yeah, absolutely. And this is actually an opportunity to really talk about what's been going on more broadly in the industry. We overinvested, and there's no other way to say it. So if we think back 7, 8, 9 years ago in midstream, we built too many oil pipelines, we built too many gas pipelines, and they were underutilized. Over the last few years, volumes in the United States are growing. We're now at record production. And what that's led to in West Texas specifically is we've got plenty of oil pipeline capacity still, but we've used up essentially all of our natural gas capacity. So with the start of Matterhorn, which just started a few weeks ago, what we have is 2.5 billion cubic feet that is trapped currently in the basin, negative pricing. What that means is you can't flare natural gas anymore in any large quantities. You have to curtail production of oil in order to curtail production of the natural gas in West Texas.
Because as I understand it, when you're fracking for oil in the shale areas of West Texas, natural gas is a byproduct of that. It comes out with the oil as part of the fracking process. Do I have that right?
That's exactly right. So when we think of production of oil, you're going to produce some oil, you're going to produce other hydrocarbons, condensates, NGLs, and natural gas. And I always like to simplify it as natural gas is the smallest molecule. It's one carbon with 4 hydrogens. And then each molecule gets a few extra carbons, right? So ethane is 2 carbons, propane is 3 carbons, so on and so forth. And oil is these long chains. There's dozens of carbons attached with dozens of hydrogens. And so while we think of oil as a monolithic product, it's really just these chains of hydrocarbons and goes through the whole value chain. So when you're producing this oil out of the ground, you're producing all of these hydrocarbons. And each one of those need to be separated before they can be transported long distances. So natural gas gets transported in natural gas pipelines. NGLs get transported in NGL pipelines. Oil and condensates get transported in oil pipelines. So we have enough oil pipelines. We just finished expanding capacity on NGL pipelines, so we have plenty there. Natural gas is really the constraint in West Texas today. And with the Matterhorn pipeline starting, we should see oil production actually ramp. Oil production in West Texas has been flat year over year. Even though we expected volumes to grow meaningfully this year, 300,000 to 400,000 barrels a day.
And that's in part because this natural gas is coming out and they're having to pay people to take it away? That's what the negative prices mean?
That's right. So negative price for natural gas means you literally have to pay someone to take it. In reality, in practice, what happens is instead of producing the well at full level, you'll throttle it back and you'll produce a little bit less. And so once the pipeline's up and running, you can actually throttle back up and then you'll produce more. So from a functional standpoint, we should see oil production ramp. But here's a real takeaway. We had this pipeline start on the natural gas side. The problem is we're producing right around 25 billion cubic feet a day today out of West Texas.
Wow.
And that's going to ramp to, well, depending on which estimate you look at, as high as 40 billion cubic feet a day. But realistically, 30 to 35 over the next 10 years. And so every other year, basically, we're going to need a new pipeline. And so there have been a few announcements. We've got a JV with Targa and PLX announced recently. So that one's going with the consortium of people. We've got ONEOK trying to make a pipeline called the Saguaro pipeline going down to Mexico. So there's additional infrastructure that's going to be built on the natural gas side to try to help alleviate this problem. But we're going to keep facing this problem where gas production hits peak pipeline capacity, turns negative. You have to curtail the rest of the production in order to manage that part of the equation, bring on a new pipe, and then do the same thing over and over again.
So 25 billion cubic feet a day going to 40. That's, but world production is about 100. Is that right?
U.S. production is right around 100.
US, so I mean, these are massive numbers. And then you also have, I know Qatar is also starting to ramp up their natural gas field. So what's your view on natural gas right now? How important is that going to be going forward? I know it's a cleaner burning fossil fuel overall. What's going on, you think, with worldwide supply and pricing of natural gas and its importance?
Yeah, there's no question. We've been natural gas bulls from a demand standpoint. And when we think of investing in midstream, it really is coming down to the transportation of those molecules. You're not making money off the commodity itself. And so we've been really excited investing in natural gas pipelines, those that are specifically tied to LNG export facilities, and then those that are specifically tied to utilities. We've seen a lot of natural gas demand growth with AI data centers, for example, here in the United States as well. So that is definitely happening. Here's the catch, though. These things are large projects in terms of LNG exports and in many cases utilities. These are 5 to 6 year lead time projects, right? They're large. And so you get this mismatch. A few years ago in LNG, in global LNG with the Russian invasion of Ukraine, we were undersupplied global LNG. As we look forward in the 26, 27 time period, it looks like we're actually crossing over and we're going to have too much LNG supply as the regasification facilities come online. So there's always a little bit of ebb and flow. When we look at the next few years, it looks like LNG is well supplied. But when we look out to 2030, we see that deficit again. And if you don't plan for 2030 today, you can't get a facility up and running by that time. It takes time to permit, it takes time to engineer, it takes time to build. So you're talking about the process has already started for companies like a Cheniere, for example, which is the world's largest exporter of LNG. They have already started their 2030 process because they have to make sure they have everything lined up today.
Wow, that far in advance.
That's right.
So in addition to midstream and natural gas, what other areas right now are you looking at as a senior portfolio manager, Parag, and investing? Where other areas right now are you optimistic and bullish on?
Yeah, it's, traditional energy was a few years ago thought that it was just going to go away, right? The reality is the industry overspent, right? And if we can think back to, I like talking about the dot-com boom, right? The industry overspent and they built too much infrastructure. And in the 99 dot-com boom, that extra infrastructure led to very cheap bandwidth, led to Netflix, led to social media, so on and so forth. So it created new companies out of that carnage that turned out to be some of the largest companies today, some of the most profitable companies today. Within energy, we had a similar situation where there was an overinvestment cycle. And that overinvestment cycle has now come to the other side, which is companies are taking that overinvestment that occurred years ago and extracting value out of it. So if we look at a company like a Diamondback, for example, classic E&P, produces oil that they're completely beholden to the commodity price. They're out publicly saying they are cash flow positive, free cash flow positive at $45 a barrel.
Wow.
And that's amazing. And here we are at $70 oil. That means that they're generating a ton of cash flow. Well, how did they get there? 10 years ago, these companies would say that they couldn't make money below $90 a barrel. It's through efficiency. It's through that investment that they made, that the ill investment that they made over the years, that they eventually turned into highly profitable and highly valuable assets. And so that's where I see the opportunity is the companies that have already invested in their assets and they're harvesting that cash flow. Those are the companies we think are best positioned to succeed here over the next 3 to 5 years.
Interesting. Before we wrap up our discussion on traditional energy, I have a couple of other quick questions. We were talking earlier about oil demand, and we've talked a lot about natural gas already in our discussion, but give me some insights into oil demand right now. I know OPEC's having a hard time. I mean, their target price is $100 a barrel, which we haven't seen in quite some time. Where do you see oil demand going? What's the data show right now?
Yeah, absolutely. It's oil supply and demand is it's two sides of the equation, right? You've got supply and you've got demand. And the number one question I always get asked, and I'm surprised you didn't ask, is what's the price or what's your price target for oil? And my answer to that is always, I have no clue, and I can also tell you that the futures market is usually wrong. But what I do look at, and what I have looked at or studied at for the 2 decades I've been doing this, is what are the balances of supply and demand telling me? And on the supply side today, and then I'll get into demand in a second, but on the supply side today, it really is a North America, South America story. The Americas together are all of the global net adds that we're seeing in oil supply. Canada's growing a few 100,000. The U.S. is growing a few 100,000. And this is true black oil. In addition to that, the U.S. is growing about 300,000 or 400,000 in NGLs as well. And then Guyana's growing a few 100,000. Brazil's growing a couple 100,000. So when you combine those 4 major areas, you're getting almost 1.5 million barrels a day of supply growth.
Supply increase.
And we use 103 million today. So you're looking at, just shy of 1.5% supply growth. Well, historically, demand has grown 1.5%. I should note also on the supply side, the rest of the world, like different regions are growing. So the Middle East is growing, but then West Africa is slowing. So combined, the rest of the world is running to standstill. So I don't want to make it sound like the Americas are the only place that are growing. But from just a simplification net adds standpoint, it's an easy way to think of it that way, is that the rest of the world is really just running to standstill. But from a demand standpoint, this is what's really interesting. And something I don't think really anyone is talking about is that we don't have good demand data now for 5 years running. And why is that? Well, let's rewind all the way back to 2019. Prior to 2019, we had a 50-year data set going back to the late 60s, early 70s that showed that demand grows 1.4% per year on average. It's one of the most linear growth rates that you can find out there for anything, right? And if we dig into that a little bit deeper, high price environments, you grew a little bit slower, 1.1% a year. Low price environments, you grew a little bit faster, 1.7% a year. And then if you look at it from, okay, well, what about years that you underperformed? Well, you caught up within a couple of years on the upside. What if you outperformed? Well, you caught down a couple of years later. So it was a very high mean reversion tendency process, right? So when I looked at the demand picture and I said, okay, this is interesting. We're growing 1.4%. You look at the IEA, which is, the OECD's energy arm, and the IEA puts out these estimates growing 900,000 barrels a day this year. Original estimate was 1.1 million barrels a day year over year. When we look at these estimates, that's the trend line that they're using. And it doesn't matter if you're looking at the IEA, it doesn't matter if you're looking at the US government, which is the EIA, and then OPEC. All these basically are coming down to the same trend line. And no one's really questioning the validity of that trend line. And I think that's the one thing that I think is lost on most people. So
what's your research showing that, Parag?
So the research is inconclusive. But if we look back to 2019, demand only grew 450,000 barrels a day year over year. This is pre-COVID. And you have to dig into the numbers and say, okay, why was that? Well, China was in recession. India was growing slower. Actually, they were in a short-term recession there as well. And so you had a little bit of economic issues driving that. Well, peel that onion a little bit more. China was 50% of demand growth in the decade prior to 2019. So when we grew 1.4% a year, 0.7% of that was China. Well, China was growing 8, 9% a year. Today, China's growing 4, 5% a year. EVs are at 35% penetration in China now. ICE engines are actually significantly more efficient, and they're actually causing an impact on demand as well, or incremental demand growth, I should say. So when you start piecing these puzzles together, if China's growing a little bit slower, that's going to knock off a few 100,000 barrels a day. If ICE engines are being adopted more efficiently across the world, that's going to chop off a few 100,000 barrels a day. Suddenly that 1.4 is really closer to 700, 750.
So your estimates are that the amount of demand growth is a lot lower than some of these other experts are suggesting that it may be.
That's exactly right. So
Interesting.
if demand is growing slower and supply is growing at 1.5, well, you've got a mismatch. And the mismatch means that OPEC will be out there cutting production consistently over the next several years until we see peak supply out of North America, South America.
On oil, you'd mentioned how it performs differently than other commodities. Can you explain what you meant by that?
Yeah, the interesting thing about oil is that there's a short cycle investment and then there's a long cycle investment. Offshore oil fields typically take 5 to 10 years from basically first finding the oil to getting the platforms built to actually producing. Whereas shorter cycle, which is predominantly onshore, those investments typically turn around in less than 24 months. And what's really interesting is about 40 million barrels a day. So about 40% of our oil comes from offshore and about 60% comes from onshore. What's been a big question for us is as we reach peak demand, what we know is that there is going to be a plateau. And a plateau means you have to keep investing in keeping production flat. Well, if management teams are looking at 10-year projects and 2-year projects and worried about peak demand, do they stop investing in this wedge that's 40 million barrels a day of production today and solely focus on onshore? If that wholesale shift happened, what would commodity prices do? Because where it sits today, replacing that 40 million wedge with just onshore production, you probably need meaningfully higher prices to justify looking for that oil onshore. And so we're looking at this dynamic in the past, we always think of if you're reaching peak demand for a commodity, a lot of times you're reaching peak price for that commodity. Well, is this a scenario where that may be true if it wasn't for the fact that we've got all this production that no one's going to want to invest in because of that long lead time? And so you've got that shift that needs to occur. So we look at that and we say, wow, that's a really interesting risk and a really interesting upside where you can actually see demand peaking as oil prices are peaking or even going higher, simply because you need that shift in the way capital is being allocated.
Because the investment time needed to produce more oil is a longer time frame and the demand is a little bit shorter in terms of its cycles. Is that really what drives that?
Yeah, it's really comes down to if management teams are looking at a 10-year payback period for an offshore project or a 2-year payback period for an onshore project, and they're looking and saying, oh, demand has peaked, I can't go to my board and say, hey, let me do this 10-year project, even though the returns are expected to be higher, because we don't know what's going to happen 10 years from now.
That makes sense. That's interesting.
And so that's the dynamic I'm looking at right now, saying, oh, wow, there might be a lot of opportunity on the onshore market simply because of this uncertainty that's coming down here in the next 6-10 years whenever oil demand peaks.
And the other takeaway is just because demand may be falling for oil doesn't necessarily mean prices are going to fall.
Correct.
Interesting.
And it's not really demand falling, it's demand growth is decelerating.
Yeah. Interesting.
So we're still using more for at least the next 5 to 7 years by our math.
Interesting. So are there any areas, sectors, investments that you're more bearish on or you're avoiding right now?
Yeah, so net, we just see more long-term value in natural gas. We don't see a demand peak for natural gas. In fact, with the AI data center build out, there's installed capacity today of power plants. You can burn more coal or you can burn more natural gas. Which one are Microsoft, Amazon, and Google going to decide to use? I think they're going to choose natural gas. So we're going to use a lot more natural gas. And that's just a domestic commentary, right? Like if you think globally, these data centers haven't even been built yet in places like Saudi Arabia. The chips haven't even been shipped to places like Saudi Arabia yet. So you know that this demand is coming, and we know that they want to power this with the installed capacity today, which is predominantly excess natural gas. So we see the next few years of natural gas being really exciting. We see the next 20 years in natural gas as being a decarbonizing force in the world. Every unit of natural gas today that's being exported out of the United States is offsetting coal demand. So when we think of it from a decarbonization standpoint, we see natural gas as being part of the solution, at least for the next 15, 20, maybe even 30 years. So overall, we're excited about natural gas. We think that natural gas related companies are fundamentally mispriced because of that long tail of growth. And then on the conversely, we think that oil oriented, particularly on the infrastructure side, oil oriented companies are probably going to see peak volumes and peak demand here. Sometime in the 2030s is what most people are forecasting. The question we have is, what does that plateau look like? Today we use about 70% of our oil demand for transportation. How much of that realistically can transition over to EVs? I don't know. That's a really wide estimate out there. But the other part, the 30%, that's predominantly petrochemicals and materials. And that's growing, and that's going to continue to grow.
Interesting. So there's going to be still some demand for oil.
Exactly.
On that side.
So we will be using, by my estimates, we'll be using a lot of oil in 2050. In fact, I wouldn't be surprised. Right now, it calls for a plateau. If you look at any of the agencies out there, they all are calling for a plateau in demand. I wouldn't be surprised if that's what we end up getting.
Okay, interesting. All right, well, thanks. That was a fascinating dive into traditional energy. I appreciate all of our listeners and viewers for joining part 1 on traditional energy. And part 2, we're going to dive in with Parag on renewables and clean energy. So please join me for part 2.